Imagine watching your account balance fall by half in just 3 days. Now imagine realizing it was all because of a simple psychological trap you didn't even know you were caught in. That's not a nightmare. That's what actually happened to one of the traders I worked with. He wasn't new, he wasn't reckless, but he was blind to the way his own mind was sabotaging his decisions. And here's the painful truth. Most traders make the same mistake. If you've ever felt like the market was playing games with you, it's not. It's your brain. And in the next few minutes, I'm going to show you how trading psychology is the hidden edge that separates consistent winners from everyone else. What you'll hear today isn't theory. It's rooted in over 15 years of my trading experience, in the mistakes I've seen retail traders repeat, and in the hard behavioral finance research that proves what's really happening inside your head when you hit buy or sell. Stick with me. Because by the end of this talk, you won't just understand why you've been making the same painful mistakes, you'll have tools to stop them cold. Now, before we dive deeper, let me officially welcome you. My name is Ben and welcome to Zenstock, where trading meets clarity. Here we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence. Because in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath. Clear your mind. For the next few minutes, give your trading psychology your full attention. Now, you might be wondering where all of this perspective comes from. After all, I didn't invent these insights in a vacuum. They come from years of trial, error, and research, but also from digging into some of the most respected trading references ever written. And that's where our story really begins. One of the most fascinating resources I've come across in my career is the Stock Trader's Almanac, published by John Wiley. Originally founded by Yale Hirsch, the Almanac has been a trusted guide for decades because it doesn't just look at price action, it digs into the patterns behind human behavior in markets. Take this insight. Since 1950, every down January has been followed by either a bear market, a 10% correction, or at best a flat year. The average decline? About minus 12.9%. That's not a chart pattern, that's psychology playing out on a massive scale. Traders lose confidence in January, and the effect cascades through the rest of the year. The Almanac is packed with seasonal edges like that, from the Santa Claus Rally to the summer Doldrums. But what struck me most wasn't the data itself. It was how consistently psychology shows up in those numbers. It's not just elections, seasons, or holidays that drive markets. It's fear, hope, overconfidence, and hesitation multiplied across millions of traders. That's why I always remind people, patterns in the market are really patterns in human behavior. And if you don't see that, you'll keep stepping into the same traps. But instead of just quoting statistics, let me share a story from my own experience that shows how these lessons come alive in real trading, and why ignoring them can cost far more than just a percentage point on a chart. A few summers ago, I was mentoring a trader who I'll call Mark. He was sharp, ambitious, and convinced he had finally cracked the code to consistent profits. His plan was simple: ride momentum every day, no matter the season. He thought volume didn't matter. As long as the stock was moving, he believed he could catch it. But here's what happened. It was July. The market was quiet. The big players were on vacation. Volume had dried up. Mark jumped into a breakout trade on a mid-cap tech stock, expecting fireworks. Instead, he got silence. The stock barely moved. By the close, he was down 3%. So he tried again the next day. Same story. Flat moves, sudden reversals, no follow-through. Within a week, he'd turned a solid account into a string of frustrating losses. The more he pushed, the worse it got. His frustration bled into revenge trades. His conviction turned into overconfidence. And every time he doubled down, the market punished him harder. By the end of July, he wasn't just down on his account. He was drained, mentally and emotionally. That was his but moment. He had a solid plan on paper, but he ignored the reality of seasonality, and worse, the psychology behind it. When volume dries up, human behavior shifts. Liquidity disappears. Small moves get exaggerated. What looks like opportunity turns into a trap. The turning point came when I showed him the very pattern recorded in the Stock Trader's Almanac. They called it the summer market Doldrums. Historically, volume collapses after Memorial Day, rallies fizzle, and traders are left holding the bag. Mark saw his losses weren't bad luck, they were textbook psychology, repeated year after year. That was when he made the shift. Instead of forcing trades in July and August, he built rules around seasonal awareness. He kept position sizes smaller. He required higher conviction setups. Most importantly, he gave himself permission to step back when the market environment didn't favor his style. The result? He saved his capital and his sanity. By October, when volume returned, he was sharp, patient, and ready. Instead of fighting the market, he flowed with it. And that shift in mindset, more than any technical indicator, was what allowed him to recover his losses and move forward as a stronger trader. What Mark learned is what I want you to take away right now. The market isn't random chaos. It's human psychology on repeat. The patterns we see in the Almanac are really just the same mental mistakes, the same habits, playing out year after year. And if you recognize them, you don't just protect yourself, you gain an edge most traders never even realize exists. Now, hearing that story, you might be asking, okay, but what's the bigger picture here? What's the main lesson I should carry into my own trading? That's exactly what I want to unpack next. So here's the bigger picture. What happened to Mark wasn't just about low volume in July, it was about the way trading psychology blinds us to context. We see what we want to see, not what's really in front of us. The Almanac called it the Doldrums, but what it really highlighted was the predictable way traders get trapped by their own expectations. And that's the real topic of this talk, how market patterns are really human patterns. If you understand the seasonal cycles, the election year effects, the Santa Claus Rally, you're not just memorizing trivia. You're learning to see the fingerprints of psychology on the market itself. But here's the catch. This isn't about predicting the future with a calendar. It's about protecting yourself from the traps of overconfidence, impatience, and fear. Because if you don't recognize those forces, you will repeat the same mistakes, no matter how skilled you are with technicals or fundamentals. That's why we're here. To break down the most important psychological lessons hidden inside market history, and to translate them into practical rules you can use today. And before we go further, I want to be clear, nothing here is financial advice. This is about education, about sharpening your edge by mastering your mindset. Always do your own research before you put real money at risk. Now that you know the theme, let me show you the one sentence I come back to again and again, the idea that keeps me grounded no matter what the market throws at me. For me, it all boils down to this. Trading isn't about predicting storms, it's about learning how to sail through them. You can't control the waves, the wind, or the season you're in, but you can control how you set your sails, how you read the currents, and how disciplined you are when the sky darkens. That's the high-level takeaway I want you to hold on to. The market is a mirror of human psychology, and if you can master your response to it, you'll always find a way forward. Think about it. Two traders can face the same chart, the same news, the same price action. One panics, the other stays calm. One forces trades, the other waits for alignment. The difference isn't the market. The difference is mindset. That's why I say your greatest edge isn't a secret indicator or the latest AI-driven scanner. It's how you manage yourself when the pressure's on. That's the sail you set. That's the anchor you carry. And now that we've framed the big picture, let's get practical. I want to walk you through the core lessons, drawn from the Almanac, from behavioral finance, and from years of trading in the trenches, that can turn this metaphor into concrete rules you can apply tomorrow. Morning. Every January, traders talk about the January Barometer. And for good reason. The Stock Traders Almanac points out that since 1950, every single down January has been followed by either a bear market, a 10% correction, or at best, a flat year. The average decline after a down January? About minus 12.9%. That's not a myth. That's decades of data telling the same story. But here's where it gets interesting. The numbers aren't just about the calendar, they're about psychology. When traders take losses right out of the gate in January, confidence cracks, fear spreads, recency bias takes over. People anchor to the bad start, expecting the rest of the year to unravel. And when enough traders act on that fear, selling early, cutting exposure, abandoning plans, the weakness becomes self-fulfilling. I've seen it firsthand. Years ago, one of my students started strong in December and felt unstoppable. Then came January. The market opened weak, and by the second week he was already down 5%. Instead of stepping back, he panicked. He dumped trades too early, sat out rallies, and second-guessed every entry. By March, he wasn't just down, he was mentally exhausted. That's the but moment. He had a strategy. But the sting of January losses made him doubt himself. And the moment doubt took over, his execution unraveled. When I showed him the Almanac's January data, the light bulb went on. He realized he wasn't cursed, and he wasn't alone. This was a pattern that had repeated for 70 years. The problem wasn't the market. The problem was letting January rewrite his expectations for the entire year. So he rebuilt his rules. Instead of treating a down January as a personal failure, he treated it as a signal. Reduce size, protect capital, stay patient. And when the inevitable overreaction passed, he was ready to step back in. Here's the takeaway. A bad January doesn't mean you've lost your edge. It means you need to sharpen it. Recognize recency bias when it shows up. Ask yourself, am I reacting to data or to my fear of starting the year behind? That simple awareness can save you from compounding mistakes that cost far more than 12%. And if January teaches us how fear distorts our decisions, summer shows us the other side of the coin. How overconfidence can quietly drain an account. If January is where fear takes over, summer is where overconfidence quietly sneaks in. The Stock Trader's Almanac calls it the summer doldrums. After Memorial Day, trading volume historically collapses. Liquidity dries up. Breakouts fizzle. Rallies are short-lived and often end in sharp pullbacks. It's one of the most reliable seasonal patterns on Wall Street. But most traders don't want to hear that. Summer feels slow, and slow feels boring. And when boredom hits, impatience follows. Traders start forcing trades just to feel active. They believe they can outsmart the season. And that belief, that overconfidence, is exactly what gets them trapped. I remember another trader I worked with, a guy named Alex. He was convinced he had found his rhythm in May. His strategy thrived on momentum. So when June rolled around, he doubled his position sizes, expecting the same follow-through. But by July, the market had shifted. Liquidity was gone. Stocks looked strong one day and collapsed the next. He couldn't exit without slippage, and his winning streak evaporated into weeks of chop and losses. That was the but moment. His system hadn't broken, but he ignored context. He thought his success in May proved he was in control. The truth was the opposite. He was fighting a seasonal pattern that had humbled traders for decades. When I showed him the Almanac's data on summer volume, he realized the problem wasn't his charts or his execution. It was his psychology. His need for action blinded him to the reality of the environment he was trading in, so he adapted. Instead of pressing every day, he scaled back in July and August. He used the quieter months to review his journal, backtest setups, and refine rules. He let the market dictate when it was worth deploying risk. And when full volume returned, he was sharp, rested, and prepared, while most traders were still licking their summer wounds. Here's the point. Overtrading in the doldrums is like trying to sprint through quicksand. The more you fight, the deeper you sink. Awareness is your lifeline. When volume drops, shrink your size, tighten your rules, or take a step back entirely. Doing nothing is sometimes the most profitable move you can make. And just when traders think the pain of summer is behind them, another force arrives to test their discipline: politics. Because election years don't just shape policy. They shape psychology in ways that catch traders completely off guard. Politics and markets have always been intertwined, but the Stock Trader's Almanac highlights something many traders miss. The first 2 years of a president's term are historically the weakest. Post-election years often bring corrections, recessions, even wars. Why? Because once the campaign promises fade, reality sets in. Hard policies get pushed through. The piper must be paid, as the Almanac puts it. But here's where psychology enters. Traders expect elections to bring clarity. A new leader, a new agenda, a fresh start. Confirmation bias kicks in. They look for signs that their political views align with market direction. If they supported the winning candidate, they feel overconfident. If not, they brace for disaster. Either way, emotions replace discipline. I saw this play out after one election cycle. A trader I knew, let's call her Sarah, believed that the incoming president's policies would supercharge renewable energy. She went all in on solar stocks in January, convinced it was a can't-lose bet. At first, she was right. Prices spiked on optimism. But by April, reality hit. Congress stalled on legislation, subsidies were delayed, and global supply chains threw curveballs. Those solar stocks collapsed, taking her portfolio with them. That was the but moment. She had conviction. But her conviction was built on politics, not process. She thought she had certainty, when in truth, the uncertainty of new policies made the market more volatile, not less. When she looked at the Almanac's data, she realized this wasn't personal failure. It was a recurring cycle. Post-election years often punish traders who lean too heavily on political narratives. Markets don't trade on campaign promises. They trade on how those promises collide with reality. Sarah shifted her approach. Instead of treating elections as a trading catalyst, she treated them as a caution flag. Reduce exposure. Wait for policy to move from headlines to actual numbers. Trade what the market confirms, not what politicians promise. And that simple shift spared her from repeating the same mistake in the next cycle. Here's the takeaway. Politics tempt us with the illusion of control. But markets thrive on uncertainty. When you tie your trades to who sits in office, you're handing over your discipline to forces you can't control. Recognize the cycle for what it is, a period of elevated risk, and focus on what you can measure. And if politics remind us how little control we truly have, the holidays reveal something even trickier. How easily we fool ourselves into believing in free money. One of the quirks the stock trader's almanac is famous for is the Santa Claus Rally. Since 1969, the last 5 trading days of December and the first 2 of January have delivered an average gain of about 1.3%. It sounds small, but compounded over decades, it's one of the most reliable seasonal patterns ever recorded. But here's the kicker. When Santa fails to show up, trouble usually follows. The Almanac notes that missing this rally often precedes bear markets, or at least gives traders a chance to buy stocks lower later in the year. In other words, when the usual burst of optimism doesn't arrive, it's a warning that psychology has shifted. This is where so many traders slip. Optimism bias creeps in. They believe December is a gift, a time when the market is supposed to hand them easy profits. They chase stocks into the last week of the year, expecting free money. And when that rally fails, they're blindsided. I saw this firsthand with a trader named Kevin. He had a good year, but he wanted to finish strong. December came, and he piled into positions, certain the Santa Claus Rally would lift everything. But that year, the rally never came. Markets slid into January, and by the first week of the new year, Kevin had erased nearly half his annual gains. That was his but moment. He had worked hard for 12 months, but he let December's history blind him into thinking history guaranteed the future. Instead of protecting his wins, he gambled them on a seasonal pattern. When I walked him through the Almanac's warning that Santa's absence often signals weakness ahead, he realized he'd missed the real edge. The edge wasn't in betting on the rally. It was in respecting what its failure meant. From then on, he flipped his mindset. If Santa came, great. If not, he treated it as a yellow light, time to tighten risk and watch for larger cracks in the year ahead. Here's the lesson. Seasonal edges are probabilities, not promises. Don't let optimism bias convince you otherwise. Respect the signal when it works, but protect yourself when it doesn't. And that brings us to the deepest truth of all. Because while market patterns are helpful, none of them matter if you don't have one thing, discipline. And the single best way to build it? Write everything down. One of the most overlooked but powerful lessons in the Stock Trader's Almanac comes from GM. Loeb's battle plan for investment survival. His advice was simple: write things down, keep a checklist, record the ruling reason for every trade. On the surface, it sounds basic, but in practice, it separates disciplined traders from those doomed to repeat the same mistakes. But here's the psychological trap. Our memory isn't built to be objective. Traders convince themselves they knew it all along. They smooth over bad decisions in hindsight. They anchor on selective memories that protect their ego. And without a written record, they rewrite their own history in ways that keep them stuck. I've seen this pattern countless times. One trader I worked with swore he had a winning system. Every time we reviewed trades, he claimed the losses were exceptions, The winners, he said, were proof his approach worked. But when we finally pulled his broker statements and lined them up against what he thought happened, the reality was brutal. He was losing money steadily, and his memory had edited out half the story. That was his moment. He believed he was disciplined. But his lack of written rules let bias run wild. His brain had been protecting his ego at the expense of his account. When he committed to journaling, everything changed. He wrote down every trade, entry, exit, size, reason, and result. Within weeks, he saw patterns he'd never noticed before. He realized he was cutting winners too early, holding losers too long, and trading twice as aggressively after a loss. None of that was clear until he saw it in writing. The Almanac was right. Writing is the fastest path to clarity. It forces you to confront your real habits instead of the stories you tell yourself. And when you see those habits on paper, you can finally change them. Here's the bottom line. If you're not journaling, you're guessing. And in trading, guessing is just gambling with better marketing. Writing things down won't guarantee success, but it will guarantee awareness. And awareness is what builds discipline. And that brings us full circle. Because now that you've seen how psychology hides in January, in summer, in politics, in holiday rallies, and even in your own memory, it's time to look directly at the traps themselves. The mistakes I see traders fall into again and again, no matter how much experience they have. By now, you've seen how seasonal patterns aren't just numbers on a chart, they're psychology made visible. But even when traders understand this, they still fall into the same traps. In fact, the traps are so common, I can almost predict them before they happen. The first is recency bias. Traders overweight whatever just happened. If January's rough, they assume the year will be rough. If they just scored a big win, they expect another tomorrow. I remember one trader who had a killer run in March. He doubled his account in 3 weeks. But instead of tightening his rules, he relaxed them. By April, he was giving it all back. He wasn't trading the market anymore, he was trading his memory of March. Recency bias tricked him into thinking the past dictated the future, and it cost him dearly. The second is overconfidence. Summer doldrums are the perfect breeding ground for it. A trader stacks a few wins in May, then assumes the same setups will work in July. They ignore the environment, increase size, and press trades that aren't there. The Almanac shows this cycle over and over. Thin summer volume punishes those who think they can bend the rules. Overconfidence isn't strength, it's blindness dressed up as confidence. The third is optimism bias, which shows up loudest in December. Traders assume the Santa Claus Rally will hand them profits because it always does. But when Santa fails, their psychology collapses. Instead of managing risk, they double down, convinced the rally is just late. I once watched a trader turn a 10% annual gain into a 5% loss in the final week of the year because he refused to believe the rally wouldn't come. He wasn't trading charts, he was trading hope. These traps share one thing: they replace discipline with emotion. Recency bias ties you to the past. Overconfidence convinces you the rules don't apply. Optimism bias blinds you to risk. None of them feel dangerous in the moment. They feel logical, even obvious. But that's the danger. The brain disguises bias as certainty. Here's the good news. Once you can name the trap, you can disarm it. When you feel yourself reacting too strongly to the last trade, stop and ask, am I making this decision based on evidence or emotion? That pause alone can save you thousands. And that's exactly where we're headed next. Because once you can see the traps clearly, the real question becomes, what tools can you use to keep yourself out of them in real time? So let me ask you, are you trading the market or are you trading your emotions? When January stings, do you shrink back out of fear? When summer drags, do you force trades out of boredom? When December comes, do you lean on hope instead of risk management? Be honest with yourself, because the fastest way to grow as a trader isn't finding a new indicator, it's spotting the moment your psychology is in control of your decisions. We've covered a lot today. From January's fear to summer's impatience, from politics to holiday optimism, and most of all, the way trading psychology hides in plain sight, shaping every chart, every rally, every correction. Now here's my challenge to you. Write down in the comments the one insight that hit you hardest today. Maybe it's recency bias, maybe it's overconfidence, maybe it's the reminder to journal every trade. Whatever it is, put it in writing. Because writing it down is how you start making it real. And don't stop there. Share this video with a trading friend who might be struggling. Someone who needs to hear that their losses aren't random, that there are patterns and tools that can help them get back on track. You never know, your share might be the spark that keeps them in the game. And if you found value here, hit like, subscribe, and turn on notifications. Not just to support the channel, but to remind yourself that every week you're feeding your edge, sharpening your mind, and committing to growth. Because here's the truth. Charts will change. Indicators will come and go. But the one edge that never fades is your ability to master yourself, master your mind, master the market. Trade with confidence and live with calm,